I think it's the same thing that makes most sense practically all of the time, and that is to consistently buy an S&P 500 low-cost index fund.
But is this still the case? Is the S&P 500 index still the best market tracking ETF that we can actually look to invest in? Because out of all of the major global indices so far this year, the S&P 500 is actually one of the worst performing ones. But it might not stop at just 6 months of comparatively poor investment returns for US equity investors, because charts like this have been floating around. It shows the Japanese stock market, which went on an insane bull run back in the late 1980s, only to go on to crash. But it wasn't so much the crash that was a problem. In actual fact, it was more so the fact that it took the Japanese stock market 3 whole decades just to recover to its previous all-time highs back in the late 80s. And now some market commentators are arguing that the US stock market could experience something eerily similar. So could the US stock market be at risk of a similar fate? Should we be looking to broaden our investment portfolios into perhaps other markets? Or should we ignore the noise, sit tight, and simply not deviate from our overall investment strategy? Well, in today's video, I'm going to present some research on this very topic, then we'll come to some conclusions within the next 10 minutes or so on potentially what the best course of action is to take. So if that sounds like something you're interested in, then be sure to stick around. So the first thing that I want to talk about is the asset bubble, and there are 3 main factors that actually cause this asset bubble that everybody talks about. The first factor being a rapid rise in prices. Second, overheating economic activity. And thirdly, a sizable increase in the money supply. Now, the reason why we're starting here is down to the simple fact that the S&P 500 actually rose 106% in just 18 months, taking us to an absolute all-time high for the US stock market. Now, following that, inflation has risen to 40-year highs, and a ton of monetary stimulus has magically been created out of thin air. So I think it's probably quite fair to say that the asset bubble criteria has certainly been met. But with the S&P 500 now being down 20% year to date and actually being in a bear market, could this asset bubble have potentially now burst, which could inevitably go on to have catastrophic effects on the long-term returns of our investment portfolios? After all, I did mention Japan at the start of the video, and there's certainly a good reason for that, because they too met the 3 factors of an asset bubble back in the 1980s. And as a result, their stock market collapsed too, so let me give you a bit of an overview of exactly what happened. The downfall began back in 1987. Off the back of a recent recession, the Bank of Japan started to engage in quantitative easing, and they did that in order to try and help stimulate the economy. However, this did inevitably go on to result in a huge increase in the money supply and credit, resulting in inevitably a huge acceleration in asset prices. The Japanese stock market rose 300% in 5 years, land prices rose at a record 45% in a single year, and house prices rose 30% within 3 years. All of which sounds all too familiar to what we're currently experiencing, not just here in the UK, but also across the Atlantic as well. However, whilst economic conditions are certainly similar, and let me reiterate the point around them being similar because they're certainly not identical. And as such, I want to look at the next layer of variables which actually affects and determines the total value of a stock market. Because as I was doing my research for this video, I stumbled across a clip from Warren Buffett during his 2021 Berkshire Hathaway AGM, where he actually spoke about back in the late 1980s how 4 of the top 5 companies in the world by market value were actually Japanese. And all 4 of those companies were actually Japanese banks. And of the top 20 companies at the time, over 50% of them were also Japanese. Whereas if you look at the list of top 20 companies in the world in 2021 by market value, you can actually see that 4 of the top 5 companies are actually American, including Apple, Microsoft, Amazon, and Alphabet. And again, of that top 20, over 50% were also based in the United States. Now you might be thinking, well, why on earth is this important? Well, I think it just goes to show just how quickly that global markets can actually change. Not only have we had a complete shift in terms of the geographical powerhouse at the time by market valuations, but we've also had a complete shift in the industries that also provides the best return on investment as well. We've simply gone from Japan to America and from banking to technology. And I think that's where it's important for us as investors to never assume that an investment in a specific country or perhaps in a specific industry, which may have worked in the past 20 years, may continue to work 20 years into the future too. And as such, I think it's important for us as investors to actually remain open-minded about where the potential best returns may be. Now, whilst we're talking about investment returns, there are 5 key pieces of criteria that you're certainly going to want to know about that fundamentally drive investment performance. You've got revenue growth, gross margin expansion, price to earnings growth, dividends, and share buybacks. And over the course of the past couple of decades or so, obviously the US stock market has very much had that winning criteria. We've seen a huge influx in demand for technology products, which naturally speaking are pretty high profit margin businesses anyway, which obviously then goes on to drive higher price to earnings ratios, and therefore the potential to pay some of that retained earnings back to their shareholders via the means of a dividend, and then also using all of the excess and surplus profit to also engage in share buyback programs too. It's certainly what was and has been the contributing factors to create the asset bubble which we've seen. It's what resulted in the Japanese stock market going on to trade at 70 times earnings, and it's also what caused the US stock market to have an inflationary adjusted price to earnings ratio at the absolute peak of the market of about 37 times earnings. However, things are now starting to change because all of this growth has actually finally caught up with the US market and has actually caused some quite significant economic challenges. The core one being the cost of living is absolutely soaring out of control. Just in the past year alone, food prices are up 10.1%, fuel prices are up 36%, and with the Fed going on to increase interest rates by 75 basis points in the last rate hike, the monthly repayments on a $350,000 mortgage would now be 22% higher just by accounting for the Fed rate hikes alone. And that discounts the fact that the banks may apply additional premiums on top of that. Yet, whilst we're only recording inflation rates just over 8%, the true cost of inflation certainly feels far higher. I'm actually not quite sure how the central banks can get away with fudging the figures so much that kind of makes inflation feel somewhat low to what it actually is in reality. But despite this, we can now certainly start to see how this could go on to affect many of the big US companies that have seen huge amounts of growth over the course of the past couple of decades. Because consumers really are now being backed into a corner. They're now kind of stuck between a rock and a hard place, thinking about whether they should cancel their Netflix subscription, potentially cancel their gym membership, as well as perhaps cancel a well-needed shopping trip because they know that they've got to cut back in order to still maintain their monthly mortgage payments at the end of the month. And as a result, that certainly has an effect on those 5 core factors that affect the total valuation of a stock. So with it being extremely likely that a recession is certainly on the horizon, and with the stock market continuing to fall down in value, there's certainly a big question mark as to the time frame on how long it's actually going to take for the US stock market to actually recover. And on top of that, there's a further debate around the potential for a lost decade of investment returns, which, just to be honest with you guys, isn't massively uncommon because the exact same thing happened after the dot-com bubble burst back in the early 2000s, because it actually took the stock market just over 13 years to recover and to actually truly go on to make new all-time highs. So after a period of unprecedented growth and the longest bull market in history, could we be looking down the barrel of something similar? Well, I think, personally speaking, it's something that investors simply can't write off, which obviously sounds quite terrible and probably not the piece of information that you probably wanted to hear whilst watching this video, but you do still have a couple of options in order to make a profit during any kind of market downturn. The first and the most simple one being is to simply continue to cost average into the market. Because if you cost average into the market as it continues to fall down in value, you will gradually reduce your cost basis. And therefore, simply based on the natural mechanics of a stock market, you will, over a 10-year period of time, only ever go on to benefit. Because to give you guys the numbers of the 13 years of lost returns, so to speak, it was only 4 of those 13 years where the markets were actually declining. So in actual fact, over 70% of the time, you would have looked at your investment portfolio day by day, and from one day to the next, your investment portfolio would have actually gone up in value. And as such, continuing to invest perhaps on a monthly basis into the stock market as it fell down in value would still warrant you a return on investment. Now, whilst you might not certainly expect to see the 10 to 15% plus rates of return, which we've certainly become accustomed to most recently, you will, based on statistical market averages, receive anything between 5 to about 9% rate of return over any single 10-year period, which for a decade of lost returns isn't so bad whatsoever. But let's say you've been completely put off by investing into the US stock market. Perhaps you've lost confidence about its future in the short term. What other options do you have? Well, the short and simple answer is to simply become a global investor. Don't lock yourself down completely to the US market, because let's say there is 10, 20 or perhaps even 30 years of lost returns for US stock market investors, then you may potentially never go on to achieve the investment goals which perhaps you've once set out. So to kind of combat this, one option that you do have is to invest into something like a FTSE All-World ETF, which over on Vanguard has a ticker symbol VWRL. A fund like this gives you complete exposure to global markets. It's of course still mainly weighted to US equities, but it does still equally give you exposure to Japan, the UK, China, Canada, France, Switzerland, and many other geographical locations. I guess it certainly mitigates that single market risk of investing purely into US equities. And what you'll certainly find with weighted indexes like these, if the US stock market and the value of the US stock market starts to fall down, and perhaps let's say the UK stock market starts to pick up in value and performs better, then actually the weighting towards US stocks within that fund will reduce and the weighting towards UK stocks will actually increase. So it should, technically speaking, reduce the volatility within your investment portfolio, along with potentially maximize your investment returns too. But in short, for now, I'm personally not going to be making any drastic changes to my own personal investment portfolio. And instead, I'll continue to cost average my way into the market as I've previously done so, and if my market returns are slightly lower than normal in the next couple of years or so as all of this kind of plays out, then so be it. As long as the value of my investment portfolio goes up over time and gives me the opportunity to perhaps retire a few years early, or perhaps just use that money for something meaningful, then I'll certainly be happy at the end of the day. So with that said, guys, be sure to let me know what your thoughts are down in the comment section below. And if you do want to check out exactly what I'm doing with my own personal investment portfolio right now, then be sure to click on this video here. And with that being said, I'll see you over in the next one.